Okay, so we're ready to start Chapter 3. Just to start, though, I want to review the things we learned in Chapter 2 on starting an accounting business. There was 4 things that you have to do before you can really start your business. The first one is to make a chart of accounts. Remember that a chart of accounts does not have any money in it. It just lists your assets, your liabilities, and your capital, and it gives an account number for each one of those sections. Once you have your chart of accounts made, you then do a beginning balance sheet. So once again, your assets go on the left side, your liabilities and your capital go on the right side. You do not attach any account numbers, only the balances of each of the accounts in your balance sheet. You have to make sure that your debits equal your credits, and if they do, you double underline each side to prove that it balances. Once you do your balance sheet, you then are going to take those beginning balances and transfer everything into your general journal. From your general journal, you're going to post to the general ledger. And each account would have its own ledger, which we would visualize as being like a recipe card. Anytime you did any transactions with that business or that account, you would record the business on that piece of paper, which is your ledger. Okay, so that's how you start. Now, Chapter 3 is called Changes Caused by Business Transactions. If your business didn't do any business, you would be able to stop right here. But assuming that your business is going to be making money, it has to have some transactions. So a transaction, they change the asset, the liability, and or the equity. Each transaction changes at least 2 parts of the accounting equation. That's important to know. The reason why you have to change the 2 parts, at least 2 parts, is because the left side always has to remain equal to the right side. And if you only change one, the other side is not going to be equal. Now, just to kind of jump ahead a little bit, you can make 2 changes on the left side, and it would still remain equal if one is a positive and one is a negative. Or you can make 2 changes on the right side as long as one is positive and one is negative, because they would cancel each other out. Or you can make a positive change on the left side and the right side, or you can make a negative change on the left side and the right side, and it would remain still be in balance. Okay, so just to practice a few little transactions here, turn to 3D1 in your workbook, which is going to be on page 17, and the instructions on page 45 of your textbook. I'm going to bring up what your answer key is going to look like. So this is what you should have in front of you now. It just doesn't have any answers in it. Okay, so we're going to practice how a transaction would change either your assets, your liabilities, your capital. Now, if you were thinking left side or right side, there would be your line to divide left and right. Okay, so this one should be done for you. It says received cash from daily sales. Now, that means that your business sold something and they're getting money for it. So they're receiving money from daily sales. When that is happening, your cash is going up. Your cash is considered to be an asset. So your cash is increasing. Your business is now worth more because it has more cash. That's why there's a plus sign in the capital account. And you see how I made the same change on the left as I did on the right, so it remains in balance. Number 2, paid cash to Winsong Company for amount owed. Now, Winsong Company will be a liability. You're paying cash, it's going down, and cash is an asset. So that's why there's a minus sign here. You're paying off some of the amount of the bill that you owe that liability. So you owe that liability less money. So your assets are going down, your liability is going down. Number 3, paid cash for month's rent. Your cash is going down because you're paying money out of your company. Because money's leaving your company is worth more. Sorry, it's worth less. That's why it's being subtracted. Number 4, received cash from the owner as an additional investment in the business. We haven't really dealt with this very much, but when you own a company, you have the option to take money out of your own personal account and give it to your company so that your company is worth more. So your company's cash is increasing. And your company is now worth more. So it has been increased. That's called an additional investment. Number 5, paid cash for supplies. Now, what's happening there is your cash is going up and your cash is going down, your supplies are going up. So your cash is going down because you're paying for supplies, but your assets are going up because now your company has more supplies. So do you see how you're on the left-hand side, but one is a positive, one is a negative? Therefore, they're canceling each other out, which is going to leave everything in balance. Number 6, paid cash for the utility bill. Your cash is going down, which is an asset, and your company is worth less money because you've had to pay some money out. Number 7, paid cash to the owner for personal use. Now, if you're the owner of the company, you have the option to take money out of your company and put it into your own personal pocket. You can do that as long as you record it into your books. If you just take it and put it underneath the table without having to show for it, that would be called stealing. So you're paying cash, so your cash is going down. Because cash is leaving your business, your capital or your company is worth less. Number 8, paid cash for equipment repairs. Your cash is going down and your company is worth less because the money is having to go out. Number 9, paid cash for miscellaneous expense. Your cash is going down and your company is going down because money is leaving it. And number 10, paid cash for insurance. Insurance is considered an asset. So your cash is going down and your prepaid insurance is going up because you purchased some. So you see how we were on the left-hand side there, but they are canceling each other out, which will mean that everything will stay in balance. Okay, so that's just kind of an overview. We're going to get a little more in depth here now. Okay, so we're going to do these together. Paid cash for supplies, $15. So that is your transaction right here. To keep track of what's going on, you could use something called a T-chart. Okay, so this is your T-chart here. Anything on the left side are considered your assets, the right side is your liability and capital. So you're buying supplies, so you see how supplies is increasing and cash is decreasing. And they both go on the left-hand side of your T-chart because your assets are on the left side. And if you want, you can write that in there. Okay, so number 2, paid cash to a liability. They don't give you a name. Cash is going down. We know that's an asset. That's why it's showing it's a decrease. And your liability, you owe that company less money, so the amount that you owe them is being decreased. So that's why you'll see a decrease there. Number 3, received cash, received revenue, cash, $300. Your cash is going up, and your capital is going up. And you notice how they've changed sides on the T-chart there. Number 4, paid cash for insurance. Your cash is going down, your insurance is going up. They both are assets, so they're on the left-hand side. Number 5, paid a rent expense, $400. Your cash is going down, your capital is going down. They're on opposite sides, but they're both being decreased. Number 6, owner makes an investment of $400. So the owner is giving the business $400. The business's cash is going up, and the capital of the business is going up. Number 7, owner withdraws cash. So the owner is taking money out. The business's cash is going down, and the capital is going down because the money has left the business. Okay, then eventually what we're going to do when we get to chapter 4 is, instead of just putting increases and decreases on each of these left and right side, we're actually now, or in the next chapter, we're going to be putting in dollar values. Like in number 6 here, we would be putting $400 on each side. Okay, so that's where we're going in the future. Okay, so to practice just that, I want you to do drill 3D2 and problem 3.1, and you can use the answer keys that I've provided for you to do that one. I want you to do problem 3.2 for a hand in. So no answer key for that one. And then when you get done that, you can do the accounting terms in questions 1 to 14, and you'll correct those together in class.